Okay, so welcome again. Our session is being recorded for future playback. Again, this webinar is brought to you by the Ohio's Employee-Owned Network, part of the Ohio Employee Ownership Center at Kent State University in Kent, Ohio. We are a nonprofit training and outreach organization on the campus of Kent State. Today we have Tom Roback and Kelly Almond of Blue Ridge ESOP Associates, and our session today is a basic ESOP administration primer. So Tom, it's all yours.
Great. Thanks, Jay. And we just wanted to thank you again for this opportunity. We think so much of the center, and you've got a great resource there. Really, the oldest state center, and really you're in good hands there. So we certainly encourage any participation in any of their future webcasts and live meetings, etc. So
Thanks.
Let's see,
that
Jay.
was unsolicited.
Yes, exactly. Okay, so let's move ahead here. And they say there's nothing basic about ESOP administration, but we'll do our best. We do want to keep it as basic as possible. There's going to be other sessions in the future on a more advanced nature, and certainly we're going to open the phones up at the end if you have any questions, and you'll have our contact information. So I'm going to handle the first few slides here, maybe the first half of the presentation, with help from Kelly, who is your local resource. She's one of our 2 administrators we have in Ohio. Does excellent work for ESOP and 401k administration for our clients. So we're going to go over some of the basics. I'm going to handle most of the compliance testing, and then hand it off to Kelly for some of the more complex S-Corp compliance testing and more discussion on distributions and diversification. So moving on here, I think before the plan year starts is an important period. We like it and always try to reach out to our clients, encourage a conversation, before the plan year starts for calendar year ends. That's usually in December. So maybe a kickoff call, that kind of thing. I think that's effective just to get ready and kind of get everybody on the same page with what's starting to happen and plan for a good year. And in doing that, I think it's important to talk about what went well the previous year, there may be some opportunities for improvement in certain areas, ways we can shave down a few days on being more timely. So so that's always a good discussion to have, and we encourage that with our clients. Certainly important to gather up any amendments that happened in the previous plan year, anything that happened that was material in any nature there. We would need to know about that. I know every company has little secrets on different key employee awards and things like that. We're gonna talk about how it is important to share information completely with your provider, just so your work's done accurately. And we do, in fact, one of Kelly's clients came in with a compliment even just this morning about how effective she's been with her clients, and all of our administrators are, about putting together a tailored timeline each year. And this is the time period to do that. So it's funny when you put goal dates down on a piece of paper, you're a little more likely to meet those. So we're going to go through in the next slide. Kelly's going to help me walk through a standard timeline, but we want to meet your needs. So certainly we could do the first draft, or you could do the first draft, but at the end of the day, we want to get together a timeline that's reasonable and to meet your needs. So. Certainly there is a year-end data request. We can gather that up from you hard copy, or we do have an electronic form that works well. You can be grayed out as to how you filled it out the year before. There is a deadline at the end of the year for required minimum distributions. You get a little leeway for the first time an individual is eligible for an RMD, but on an ongoing basis, that is a hard stop at the end of the year there. So let's move on. I wanted to integrate Kelly here, and who's really in the trenches. And as you can see in the blue, those are some responsibilities on your provider's end, and then in the red are just some of the things that we would need from you in order to meet your goals or delivery date of your work. So, Kelly, why don't you chime in and maybe kind of walk through it for the group?
Right, absolutely. I've actually found the timeline to be very beneficial when working with the clients. What we like to do is actually work closely and tailor a timeline. A lot of them do revolve around, well, when is the end date going to be? When do we need the certificates? Is there a company celebration? Is there a company meeting? But all of it does start out at the end, or actually the end of the plan year when we send the year-end information to the client. And this is filled with all kinds of questions and information that we have that we do ask for confirmation. And this, we normally send it via email, and there's a link so electronically you can click in. It's a web-based program that most clients find very easy to work through, and we as an administrator can actually walk you through it if there's any questions. And we do work very closely with you to get it done. And in that process, there is a request for census and any financial information, meaning, you know, what happened during the year, was there new transactions. We do request that. And once that is sent to us, on this date in the red, we have 2/15 client send census and financial information. Once we do receive that, we go through and review all the census and financial information that we have received, and we send back questions and verification of the information that you did provide. We want to make sure that all the information is accurate, and any small questions that we have, we want to get answered on the front end so they're not coming up later on in the allocation. We usually give about 2 weeks for the questions, and then the next step, if we're missing any financial information, we do ask for that. We try to be proactive with it and ask during the initial process. And that would be on there. We have 3/8. And then after we receive all the answers, we ask for your approval on what we call a census verification. And this would be all the information that you've provided, the census data compiled, as well as what we have calculated to be eligible compensation. We ask for your approval on that, as well as any of the plan financials and what occurred during the plan year. This gives us a good base for the allocation, and we know that you agree with what we show as happening. Once we get approval on that, it kind of becomes a waiting game where we have to wait for the updated stock value to come in. On here, that would be May 1st. That does vary per client. And once we receive that updated stock value, we give ourselves about 30 days to complete a preliminary allocation. We have a very good head start by having the census verification approved as well as the financials. Once we have our preliminary allocation done, we send that to you for your approval, and we go through any questions that you may have on it. Once we receive approval from you, then we will go ahead and print the participant statements and certificates, and then they get loaded into ESOP Connection, which is our online viewing of the certificates. Once that's done, participants receive their certificates, questions are answered, then we go ahead and we prepare the Form 5500 and all the related schedules. We work with you to have that signed online. And there is a lot of back and forth with you. We just want to make sure that everything is done accurately and timely, and that we're getting things done when you need them done.
Thanks, Kelly. Yeah, so as you can see, we spend a little extra time in the census process. It's time well spent, though. We certainly, because that's really the building blocks. If there's some, little errors there or bad information that we get, then it could, cause you a hassle down the road. So we just double check there with our systems and our professionals, scrubbing that down, thoroughly reviewed, and come back to you in an orderly manner on that. So I'm sure your provider is doing that, and obviously you want to make sure that it's done thoroughly. So, okay. Just moving on here, talking about the administration process. So we're into the plan year. We'll help you. Your provider will help you determine eligibility, and you do have a responsibility for newly eligibles, technically within 90 days of becoming eligible under the plan, to get them a summary plan description. So that's a possibility there, but hard copy. Most use hard copy. Could be done electronically if you wanted that. The same with beneficiaries forms. I know these can be a little bit of a struggle for clients. You can't. It's hard to get everyone to turn them in, and there's some things that come off, changes in people's lives. We do have the capability of an electronic form on ESOP Connection for beneficiary forms. Works well as an option there. If you're not selecting your spouse, though, it has to be hard copy. So it can't, there's no e-notarization yet, but so that's something to remember and keep on top of best you can there. Moving along, as far as the data request, I think we kind of covered this, your financials through the timeline. Kelly was talking about the information that we gather. We do have an electronic form as an option. We call it the electronic year-end letter. So it'll be grayed out as to how you filled it out last year. If there really weren't any changes in any of your information, with as far as maybe you're still a C corporation, your plan year end hadn't changed it quite a bit, could be the same. So it maybe helps you fill out that form and get that. The main thing is just get good information from you. Make sure there wasn't a new event of some sort. And of course, the stock valuation that we're going to gather. Typically, we try to do everything we can up front, scrubbing the census down, doing your trust accounting, because typically the stock valuation would be the last piece of information we get from you. So your provider, definitely appreciates getting things ahead of time. It's not ideal if we get everything at once, including, we've had a few clients in the past that do say, hey, we'll just send them the census once we get our stock valuation, and that just really, that's not the best way to do it. So, it's better to get everything rolling, and then is the last. Certainly, whether your release is principal or principal and interest, we track that with your amortization schedule. I know the Department of Labor came out most recently at the conference, I guess it was in November, and shared that that share release needs to be out to 4 decimal places. So that's something that we came back and made sure that our clients are in compliance with that. I think most did that. Wasn't a problem. So the statements, both physical and we did capability for electronic statements, available on our online tool. And really getting ready for the 5500. Ideally, if the client permits. Would like to get everybody done and done by July 31st for the calendar year-end plans. But some, for whatever reason, clients do want to go on extension. That's not a problem. Doing that form 5558 extension form. The EFAS 2 process has been in the second year. I think it's gone pretty smoothly, and so it is required now. It's a different day and age. So everything, and instantly the governmental entities will be able to pull up those filings and want complete information. So that's certainly a priority for us on that. Okay, so let's talk a few minutes about some basic the compliance tests that you're going to have to we're going to have to complete for you.
Tom, could I cut in for 1 sec?
Go ahead, Jay.
Yeah, this is Jay. Quick question. Your timeline is prepared based on the assumption of a 12/31 plan date, right?
Mm-hmm.
Are the vast majority of your clients on a 12/31?
Good question, Jay. Yeah, I'd say well over 70% are on a calendar year and plan year. We do have some, we have clients in every month of the year, and so that helps a little bit. No hiding that they get maybe a little more individual attention, but busy season is busy season, and that's just a reality that we are certainly accustomed to.
Sure, that schedule allows you to kind of plan your workload internally as a TPA.
Yeah, definitely. Yeah, that's there's a lot of thought goes into when a new client comes on board as to who has not only the complexity of plans, but the timing of the plans there have to be measured, and make sure that we're going to give them as much individual attention as possible.
Good, thanks.
Okay, good question. Okay, so compliance testing, before we get into compliance testing, just wanted to offer up, certainly for clients if they want a preliminary compliance test, if they're worried about certain compliance tests or had problems in the past, not a problem. We can run anything preliminarily for them. And really the first step in running these tests for your plans have to do with defining certain employees as a highly compensated or non-highly compensated, or a key employee that we'll get into that definition too. So you can see on this slide the definition of highly compensated employee, an individual earning $115,000 was just inflation adjusted up for this year or more in a prior year, or in your plan document. Of course, you have an individually designed ESOP plan document. You could have included, and some of our clients do have, a top paid group definition. So, and this can be beneficial to some clients if they're having some failures. Really, this definition helps frame the 410B coverage test that I'm going to talk about in a few moments. That's specific to your ESOP. And so this top paid group, you can actually put a definition or provisions in your plan document that say that we're going to define our highly compensated as the top 20% of compensated. So, and sometimes some people that in the normal definition would be over this 115, when you define them as the top 20%, they're not actually highly compensated, and it may be the difference and allow you to pass that compliance test. So you also could be a highly compensated if you own more than 5% of the company stock in the current year or the preceding year. Okay. Let's see, I keep doing that. All right, so that moves us on to the next definition of key employee. And this definition is important for defining a key employee in context of the top-heavy Code Section 416 compliance test. And this was just inflation adjusted up again. There's 3 different ways you could be defined as a key employee for this particular compliance test. Number 1, if you're an officer that's earning over $165,000 in the current year, same 5% owner in the current year definition if you're greater than 5% stockholder, or, and this third one is not ever inflation adjusted for whatever reason. I don't know why, but if you're a greater than 1% owner in the company stock in the current year and you own more than $150,000. Okay? So those definitions, your provider's going to calculate those for you, and they're going to help you start out running your compliance tests. There is the first compliance test we're going to talk about is the maximum deductible contribution. It's Internal Revenue Code Section 404 test, and this test is aggregated amongst your plans. However, the elective deferrals in your 401k plan are netted out of this, so they are not included. They're excluded from this compliance test. They used to be included before 2001 ECTRA came into play, but now they're not. So it usually leaves leaves more room for you there, and really this has to do with your deduction limits. And it's based in the taxable year, not the plan year. So this is a little unusual, this particular compliance test. And really the limit there is 25% of eligible compensation. Okay. Talking about carrying on with this particular compliance test, there is additional room in the test for C corporations. Not only the interest, which makes sense, but also the principal payments. You have some room there, the interest and principal there, and we don't need to get into it. But there's a 1/3 test also that's a little worth knowing about with that. The 404J, that just basically is a code section that talks about the deduction limit of 25% shall not include any benefits in excess of the 415 limit, which we're about to talk about, which is really the $50,000 a year limit individually. So, okay. And Jennifer Brewer, yes, you can have copies of this. We're more than happy to email it to you. Jay's got them too. He can email them to you, either or. So I'll just make a point to give them to you after the slides, after this presentation, and you can certainly follow up with us. Scott Freund, I know, is your main day-to-day contact too. So let's talk about another one of these compliance tests that's kind of danced around it here, the coverage 410B test that is specific, just looking at your ESOP right here. Your 401k plan has the same test, but just looks at the numbers for your 401k plan. So in an ESOP context, it's really kind of a ratio over a ratio. And this is, if you remember, we just talked about the highly compensated definition. That's what you're going to use here. So the plan, your ESOP must cover at least 70% of the non-highly compensated employees, okay, or the percentage of covered non-highly compensated must be at least 70% of the percentage of highly compensated who are covered, okay. So really, if you fail this test, that's where you can bring some additional people. We'll help work with you to bring some additional people into the plan to pass this particular test. Of course, we're looking at your plan document, and there may be some direction we like to see some direction in the plan document. Sometimes it's not enough detail, but we can look to the plan document. That's the first place we're going to look, and go ahead and provide a solution for you if you are over on this test. So again, we would work with you if you wanted to. Maybe you didn't have a top paid group provision, and maybe that would help you in this case, not have to deal with the hassle of failing this particular compliance test every year. So we could help you scope that out and see if that would be beneficial to you. Okay. The next compliance test, and we have seen some people fail this. And ESOP companies are pretty generous. A lot of times even some smaller ESOP companies, if you have a generous ESOP contribution and you have participants in the 401k plan, the limit, which was just inflation adjusted, is the lesser of 100% of compensation, or now $50,000. So if you have a $45,000 ESOP contribution and you're deferring $6,000 in your 401k plan and plus a match, you're going to be over on that. So again, we're going to be looking to the plan document for definitions there as to how to deal with overages there. Typically there's going to be a corrective distribution in your 401k plan, although we do, there's certain ESOP attorneys that have that adjustment made in the ESOP. So we're going to make sure you're covered on that. And obviously we have run into a few situations where there's some inconsistencies, so we'll work with you on that and can help you work through how to deal with that if you're over. Go ahead, Kelly.
And I've actually run into a few situations where the 401k document and the ESOP document say different things. So in those situations, we do need to work with the attorneys on the plan or with the client very closely to make sure that we're all in agreement as to where these distributions should be occurring.
That's a good point. Yep. ESOP and 401k integration. It's sometimes beneficial. So moving on here to the next compliance test. Honestly, this one, it's rare that we see a failure here. The definition that we use in this top-heavy 416 test is the key employee definition that we covered, that one with the officers over 165 and the 1% owners over 150 and of course the 5% owners. So this is a combined test, just like that previous one, the 416 annual additions test is that we just talked about. So it's combined with your 401k plan, and if they are your plans are top heavy, if 60% of the account balances and all the plans are allocated to key employees, and so it is required to be performed on a combined basis. However, I guess this is just kind of common sense. If one of the tests, unless one of the tests exceeds 60%, then mathematically you're okay. So we rarely see a failure there, quite honestly. But that's part of the deal. You want make sure your provider's running this test. And a few more bullets, just continuing on the top-heavy 416 test. Distributions made during the 5-year look-back period is to be included for all active participants, and minimum employer contributions are required if key employees receive contributions, including salary deferrals. So, okay. All right. Well, I'm going to let Kelly handle the complex compliance test for S-Corps here. So, Kelly, why don't you take it away?
Sure. And actually, the one that we're going to look at first is the 409P S Corporation test, and this is one that it's really not an option to fail. It's one that you want to make sure and plan that you're going to be passing. And for this one, I'll go over a few definitions first, so as we go through the test, we're familiar kind of with the definitions that I'm using. The first one is deemed owned shares. And these are considered to be all the allocated shares within the ESOP, as well as the shares that would be allocated from the suspense account. So your provider would be doing what we consider a mock allocation of those suspense shares, where we're allocating them the same way that your shares that were released during the year would have been allocated. And then we combine them, and then those are considered your deemed owned shares. The next item would be synthetic equity. And this is the one where it seems to cover a lot of different things, and we do ask a lot of questions on it. And you can see from the definition where it includes but is not limited to stock options, warrant, restricted stock, phantom stock, SARs, any right to future cash payment, et cetera, et cetera. There's a lot of different items that are included in there, but it's very important for us to get the accurate information so we can run the test and have the appropriate information in there. Then our next definition would be a disqualified person, and you'll commonly hear that as a DQP. And this would be individually would be a person that owns 10% of more of either the deemed owned shares, which would be your ESOP shares, and then the mock allocation of your suspense shares, and then or your deemed owned shares plus your synthetic equity. So that would be an individual owning 10% more of, or more of that. And we also look at a family, a group of family members. So that could be anyone that is related. Will combine those together, and that would be 20% or more of either the deemed owned shares or the deemed owned shares plus synthetic equity. And then our last definition would be a non-allocation year, and this is what we want to avoid. And this would be a disqualified person who owns at least 50% of the stock in the S corporation at any time during the year, and that's important that they cannot own more than 50% at any time during the year. And during your non-allocation year, no benefits may accrue under the plan for that disqualified person. So that would be your non-allocation year. So essentially, when we're looking at the test, our first step is we want to determine if there's any disqualified persons, any DQPs. And if it's determined that there's not, no further testing is required, we can stop at this point. We'll say everything looks good. If there are some DQPs, either individually or as a family, we must move on to step 2. And in step 2, this is where we determine if this is a non-allocation year. And during this test, we're looking at if the DQP owns less than 50% of the outstanding shares of the company. If they own less than 50%, the test passes. And this one, failure is not an option. We'll oftentimes see fail-proof language written into the document, kind of what needs to happen if you're getting close to that limit, and kind of how to avoid it. And that would be something that your attorney would work with you on. And
yeah,
that's
so
pretty
Kelly,
much,
essentially
yeah.
they're kind of taxed out of business if they have a non-allocation year. Of course, it's okay to have DQPs, and
right.
and we have plenty of clients that are there, but makes us nervous when our clients are up in the high 40s% wise non-allocation. But we've worked through that, and there's some good solutions there, and can run that ahead of time. We have found a lot of new ESOPs. The various practitioners, people putting the deal together, require a 409P test before the transaction. So we, and I'm sure other firms, can run that ahead of time before a transaction, just to make sure not going to cause a problem.
Tom, what are some of the risks here for noncompliance? What are some of the outcomes if you fail these tests?
Yeah, specifically there's very significant excise taxes. The business is almost kind of taxed out of business. You know, I guess some of the penalties I can look those up as Kelly's going through, and I forget the percentages of the excise taxes, but yeah, it is really failure is not an option. And you know, luckily we've seen or we've heard of some of these situations where, you know, there's alternatives and there's other ways to deal with it, lateral plan transfers, or just like Kelly said, language in the plan document that really doesn't allow for a DQP, or, you know, but it's been an ongoing thing. The good thing, you know, while this is complex, and unfortunately there was a few smaller companies that were kind of unintended consequences, were close to failing or failed even though there was nothing egregious. This has been a good rule because, you know, after '98, when the S corps were allowed, you know, to have ESOPs, these smart tax attorneys, you know, found a loophole and created some of these really these ESOPs that shouldn't have been ESOPs. These 1 or 2 person ESOPs that really benefit a few people, and you know, really is not really the spirit of employee ownership. So you know, the list from the Department of Labor, those kind of sham ESOPs back over 10 years ago were really cleaned up, and this compliance test did it. It took them a few years to tweak it. I'm not sure it's totally tweaked now. It appears to be, but there were various versions of this code section. But I think in the end of the day, it actually did what it was supposed to do. It's just really, you know, some of these small, very small ESOP companies, it is a big consideration that you know, frankly, you can't do an S corp ESOP if you have less than 10 employees. It's just mathematically doesn't work. And we have seen some instances where the synthetic equity, stock appreciation rights, or other deferred comp can have a very big impact on this compliance test. So it's definitely mandatory to run it, so your provider should be running it every year.
Right, and this is something, if we do get to the point where there's the disqualified people, we do ask to be consulted with any transactions or new additions of synthetic equity during the year, so we can be aware of what's happening and potentially run a test mid-year to make sure that if something was added, that it's not going to push it into a non-allocation year.
Yeah. Okay. All right. Go ahead, Kelly.
Okay.
Okay.
So the next slide that we have is talking about ESOP distributions and diversifications, and I'm only going to briefly touch on it. I believe there's a future webcast on this. And our ESOP distributions are directly tied to our stock value. So essentially, your distributions are going to reflect that stock value. As it goes up, the distribution amount will go up as well. And your distribution form can be changed without violation of the anti-cutback rules, meaning that the form could be cash or cash and stock or a combination of both, but a change in that would not violate any rules.
Real quick, Kelly, let me try to answer Jay's question earlier on the violations of 409P non-allocation. And essentially, I thought this was 50%. The company is subject to an excise tax equal to 50% of the amount of the prohibited allocations, and the shares allocated to the accounts of the disqualified persons are treated as having been distributed to the disqualified persons, so they'll be subject to tax on the value of those shares too. So it's a pretty severe penalty, and not something that you want to even have a chance at getting into that. So go ahead, Kelly.
Okay. And the next one is the basic timing of our ESOP distributions, and this is really the standard language. It would be your other termination that they must occur in the 6th plan year following the plan year in which the termination occurred. So essentially, if someone would terminate in 2011, their distributions could start occurring in 2017. And this could be the beginning of your installment payments could begin there, or it could be your lump sum distributions. And then for your death and disability and retirement, it would be the plan year following the end of the plan year in which termination occurs. So for a 2011 disability or retirement or death, that would begin in 2012. And these are often made more lenient in a distribution policy. This is just your basic language that they have to occur by this time. And then our next option for distributions would be your diversification. And this would be when you're age 55 and you've had at least 10 years of plan participation. And your diversification allows a participant to take out some of their stock and reduce their investment risk as they start to approach retirement. It's giving the participants that are highly vested in shares to diversify and move their funds. The general rule would be a qualified participant must be permitted during the qualified election period to diversify a certain percentage of their post-1986 stock account. And the definition of a qualified participant is a person who has attained both age 55 and has had 10 years of participation in the ESOP. And you can make these terms more lenient, but they would no longer be considered diversification. They would be in-service distributions. And when we look at the definition and we think of the 10 years of participation, those 10 years may include years in a predecessor plan if the assets for that plan were used to purchase ESOP shares. You couldn't include it if it was just a prior plan and there weren't any ESOP shares in there. And there's been discussion about whether years of participation include years after termination of employment. So this is an item where your plan document should clearly define years of participation. And years of participation could include when they were actually a participant in the plan or if they were just actively employed. And then the qualified election period, when they're actually allowed to receive the diversification of their shares, is the 6-year period beginning with the first plan year in which they become a qualified participant, meaning the first plan year in which they've reached age 55 and 10 years of participation. And if the qualified participant wishes to diversify, they must make that election within 90 days of the end of the year in which their qualified election period begins. And the amount that they are allowed to diversify is a cumulative amount, and it's 25% for the first 5 years and then 50% for the 6th year. And this would be something that your provider would be tracking and notifying you of, the amount that they are allowed to diversify each year, so you are not going over the 25 or the 50%.
And Kelly, do you see most of the individuals that are eligible for this doing the chunk, making the election that first year and then waiting till the end? That's kind of what I would do, because it seems to be a de minimis amount in between.
Yes, and that's typically what we see, and oftentimes you'll see the 25%, but you won't see the 50% go out in that 6th year. They just do that 25% and then kind of ride that, or they've retired by the 6th year. And then there's different methods that are available to meet that diversification obligation. Oftentimes we see that the plan allows the distribution of the funds directly to the participant. So the participant is paid in cash for those shares. Or those funds can be transferred into an IRA or the employer's 401k plan. So it would be a direct transfer from your ESOP into the IRA or the 401k plan. And the one that I believe, at least I have seen least often, is the offering of at least 3 investment options in the ESOP. That would mean that the cash for those shares would be transferred into an investment fund or different investment options that the participant would choose, and then the ESOP would be responsible for producing participant certificates and monitoring those funds.
Yeah, I agree, Kelly, on that. That's number 3 is never been a best practice. It's rare. And actually, in this new day and age with this 408b2 disclosure that's brand new this year, it's really another reason that it doesn't make sense to offer that. So it's just more of a hassle for you as a plan sponsor.
Right. No, I agree. And then we have the diversification must be completed within 180 days following the end of the plan year, which is typically 6 months out from the year.
Yeah. And that, I know, it may be difficult, if not impossible, for you as a company to meet that 180 days. Many of our clients, especially some of the smaller ones, they don't have their valuation then. But I guess there's some best practices there too, Kelly, with a preliminary form that can be used, even though the final, they won't know the exact share count allocation individually. But I guess we have some clients that use that as like a preliminary form, right?
Right, we do. We'll kind of send out a form saying you are eligible to diversify. We don't know exactly what the amount is going to be worth, but if the time, when that time comes, do you want to diversify? And they would have the option to check yes, and then we would follow up with this is the amount that you're eligible to diversify, and pretty much ask them what they want to do with that once we do have the updated stock value in.
Tom, Tracy has a question.
Okay. All right. So Tracy, good question. Is a transfer to a 401k governed by the maximum annual contribution limit? Are you talking? And I assume you mean the annual additions $50,000 limit. Really, in that, as far as I may need some more information on that. As far as a transfer to generally, I would say so it is the $50,000 limit. Generally, I would say no, right, Kelly, or am I missing something on that?
No, that's right. I mean, essentially, it would be for your 401k. It would be looked at as a rollover. It would be a rollover from a qualified plan. It wouldn't go into the contributions.
Yeah, no, your whole balance, no, that'd be no. It's just really for that 1 year as far as the contributions to the ESOP and the deferrals you made in that 1 year, plus any match or anything like that.
Right.
And Tom and Kelly, on kind of a spin-off from that same question, do you see most of your clients with a 401k alongside the ESOP? Is that a common practice?
Most of our clients do have a 401k plan. Most of them are separate plan documents. We do have plenty that have merged plan documents. But, yeah, it's one of the things, honestly, I think that's overlooked by people that don't fully understand ESOPs, even politicians. They say, oh, it's risky to have an ESOP. Well, you got to remember that these employees are are saving on their own with pre-tax elective deferrals in their 401k plan for their retirement. So I always think of the ESOP as just being kind of gravy on top of that, and it should be thought of that way. But yeah, 401k plans are you know, they've become very cheap to set up. It's not like setting up an ESOP where you have an individually designed plan document. You know, it's a prototype, or we use volume submitter plan documents. So it's, you know, you don't have the expense of setting that up. It's really inexpensive to set up a 401k plan. Really, really small companies have them these days. So it didn't used to be that way, but now it's really great.
Do most of the companies reduce or eliminate the contribution to the 401k once the ESOP is set up?
Good question. I think it is typical to see that match reduced, if not eliminated. Obviously, you know, you're giving a generous contribution to people and taking on debt. You know, if it's a leveraged ESOP, so you know it's going to may be tough for the company to do that. You know, have both. But some can keep the match intact, and that's typical. So obviously, just Jay, you probably run into that with companies starting out. You know, communicating that to your employees and saying, hey, you know, get ready because this ESOP, you know, if we do well, it could be a lot more significant than the match, and maybe we'll get the match back at some point.
Absolutely, absolutely.
Yeah.
And of course, that deduction limit, that 25% deduction limit for C Corps applies to all qualified plans.
Yes.
Yes.
Yeah.
Okay, we have no pending questions. I do have one, though, and maybe there isn't a good answer for this, but I'm kind of curious, Tom and Kelly. You've referred to the plan document quite a bit, and obviously you need to be, as an administrator, very familiar with the plan document. When you look at a plan document for the first time for one of your clients, are there provisions in that plan document that kind of jump out at you where you say, oh no, okay, I don't want to see this provision, or on the opposite side, well, that's a great provision from an administrative standpoint? Either, you know, the item in the plan makes it more difficult or makes it easier. Is there something that kind of jumps out at you?
We do have a few clients that have a points allocation, and I know that's more work on our end, Kelly. Go ahead, Kelly. Though
yeah, and that's what I was going to say. Yeah, and when we actually do look at the document, when we first receive it, we go through and we do our checklist of kind of the basic items that we need to be aware of. You know, your eligibility, when you're eligible for a contribution and your distributions, and different things like that. And as Tom was saying, it's those points allocations that are more difficult to administer, or you know, the ESOPs that are allowing distributions as soon as someone terminates. You know, that's kind of the ones where you're like, oh no. So those are typically what we see, but we do try to look at it right away so we can address any of the things that we see that are going to be issues.
Right, I'm sure you do. Ed Schmidt just has a question. Tom, do you see that?
Yeah, you know, I think almost all of our clients are really in compliance. First of all, I've never heard of the government really cracking down on that 100-day deadline.
You might want to repeat Ed's question for the value of
okay. Yeah, it has to do with the statutory deadline of 180 days for diversification that Kelly just talked about. You know, so I wanted to frame that. Yeah, just like the government does in some circumstances, they, you know, with ERISA, and you know, they write these deadlines without realizing the practicalities of it takes time to close your books and to get your valuation done. Almost all of our clients do at least do the best practice of a preliminary form before the 180-day deadline, that at least, at least they've gathered in, and it's kind of an indication of interest in doing the diversification and electing to diversify. But technically, they can pull out if the stock had a significant change one way or another. They could, if they really don't like the stock value that year, they could pull that form. So almost all at least do that. We do have many good size of our clients, especially honestly it seems to be the smaller companies that are getting their valuation well into the second half of the year. Some even bumping up against the 5,500 deadline in October. But we manage that best we can. We can help them in full service with diversification processing, just like the other providers, and that usually helps if we're more involved. But we're consultative on that and reach out to our clients. I think most of them are okay.
Great. Well, it's just after 11 o'clock, and I think we'll draw this to a close if there are no further questions. I really want to thank all of you for attending, especially Tom and Kelly, who I think have done a great job giving us an overview of administration issues. A reminder, we will archive this session for future listening and viewing, so please see our website for access to those webinars and podcasts. I do want to remind you of some future events that the OEOC will be sponsoring. We're going to continue our series of 5 webinars over the next few weeks. On March 20th, we'll cover repurchase obligations with Judy Kornfeld of ESOP Economics. On March 29th, we'll be doing a webinar on ESOP communications committees with Kathy Ivansy of Workplace Development. On April 5th, more administration, but we're going to dive into distributions a little more, and Pete Schuler of Crow Horwath will be doing that one. And then on April 10th, a valuation session, with Scott Miller of Enterprise Services. So please check our website to sign up for those or register, or contact me if you have a problem doing that. And also, don't forget, I'm sure most of you know that our annual conference in Fair Lawn is coming up April 20th. We'd like to see you there. This is the 26th annual conference that we've been sponsoring. You will receive an email feedback form after we sign off, so please give us some good input so we can provide future subjects that you really need and improve our presentations. So at this time, we'll end the webinar and wish all of you a good day.
Thanks, Jay.
Okay, thank you.
Thank you. Please stand by.